So we're going to go. So today's lesson is on capital budgeting. We're going to be covering the capital budgeting question within the 2019 um, November question paper. But before we do that, we'll spend about just quick 20 minutes on, or quick 30 minutes on the overview of capital budgeting. So when it comes to capital budgeting, or basically for anything, you need to be able to identify effectively the what, the why, the how, the when, and so forth. Okay. So one of the first questions you want to understand is why capital budgeting? Why is capital budgeting important? Now, what you should know that every single company would like to operate sustainably into the long term. Okay, so they want to operate sustainably long term, and that is like 20 years, 50 years, 100 years. That is how long companies would like to operate. So, in order to ensure that, they need to make sure that they have the necessary resources and capabilities to actually achieve what they need to achieve. And in doing so, they need to make regular long-term investment decisions. So that is the purpose of capital budgeting. Companies will need to reinvest into their business in order to maintain the operations or to expand the operations. And that is where capital budgeting comes in. Just take a simple example. A simple example is that of, let's say, an Uber driver. An Uber car, let's say a vehicle can last for 20 years. After 20 years, you need to replace that vehicle. As a result, um, in order for that Uber driver to maintain the operations, they would have every 20 years, they would have to replace the vehicle. If they want to expand their operations, they need to buy a second, third, and fourth vehicle. That too requires capital budgeting techniques. Now, I use 20 years for a vehicle because that is how long many people use their vehicles. But remember, with Uber, your car can't be older than 5 years. So every 5 years, you're going to have to replace. So in order to maintain your operations, that is what you'll have to do. In order to expand, you'd also have to make long-term investment decisions. If you do not do that, that is where the problem comes in. For example, if I remember correctly, a power station takes 20 years to construct, to bring it to build it and bring it into operation. So 20 years ago, Eskom supposed to start an investment project so that 20 years later, when the current plant is no longer useful, we have a new plant. So those are type of, that is the purpose of capital budgeting, to ensure your long-term sustainable, you can operate sustainably over a long period of time. As you can see, because of those investment decisions that were not made, or let me say, the lack of investment decisions, we're sitting in a problem with this power cuts and all of those type of things. Obviously, it's much bigger than that, but that is one of the aspects if you look at it from a financial management point of view. So as you can see real world examples where that is a problem when people do not continuously make long-term investment decisions. So that is the why. That is why capital budgeting is so important. So the question is, when do we apply capital budgeting? So what you should know, you apply capital budgeting when you have to make a decision regarding a long-term investment. So whenever you have to decide as to whether or not to go ahead with a particular investment or a particular project that is long-term in nature, you will fall into the domain of capital budgeting. Or if you have to decide between two long-term investment decisions, you are falling into the domain of capital budgeting. They may spin this around and ask you to evaluate. So they give you a capital budgeting and you must evaluate. You are still falling into the domain of capital budgeting because it's got to do with a decision relating to a long-term investment decision. So what is long-term? Long-term for financial management purposes, or at least for capital budgeting purposes, is any project, any investment that will generate cash flows over a period that is longer than 12 months. Okay, so when you generate cash flows over a period that is longer than 12 months, then that is considered a long-term investment. And when you have to make a decision regarding a long-term investment, you then fall into the world or the domain of capital budgeting. Now that's the theory, okay? That's theoretically, that would be the case. In the real world, capital budgeting is not always applied. In theory, it can be applied for any long-term investment decision, but in practice, it is not applied for every long-term investment decision. Typically, where it is applied, for example, sorry, typically where it is applied is, for example, like ESCOM would apply it, SASL would apply it. Why? Because it is complex projects that is being constructed over a period of 10, 15 years, and only then will they generate cash flows. So because it's so high uncertainty and it's large, huge projects, those type of companies, construction companies, those type of companies will typically use capital budgeting techniques. However, ShopRite, Pick n Pay, when they want to open up a new store, theoretically they can also apply, but they don't, because it doesn't make sense for them. Okay, they will just go ahead and go into and open up a new store. So in theory, you will apply it. In reality, in the real world, they don't always apply it. But like I said, ESCOM, most likelihood, a construction company, a property development company, company like Sasol that is creating large operations, your oil and gas companies, because it's significant investments that they are making, billions and billions and billions, that they need to spend to construct something that will generate cash flow sometime in the future. So therefore, they would apply capital budgeting techniques because they're working with large sums of money. For Pick n Pay to open up a store, that's minimal for them. For example, I think to open up a like if you want to franchise a Pick n Pay store, it's like 10 million rand. 10 million rand is nothing for Pick n Pay. You understand? I mean, okay, that's for the franchisor, maybe a lot, but let's say Pick n Pay themselves want to open it, it's minimal for them. So they're not going to still bother. Like an example, a real world example is, I remember when I was a student, our lecturer explained he happened to meet, I think the CFO of either Truworths or Foschini, one of the two, right? And he asked, I didn't know the CFO, but it was some high person in finance. So I think it was a CFO, maybe someone below the CFO. So they asked, how do they decide how do they decide whether or not they can open up a new store in a particular mall, for example? So the lecturer said he expected them to say, oh no, they do a capital budgeting technique, and that's what they do. So the answer was basically they take 5 minutes to decide. They take 5 minutes to decide whether they're going to go into a mall or not. They don't apply capital budgeting. Their thinking is as follows. If I go into the mall, they use like a 4-quadrant. So if they go into a mall, and the mall is not successful, most likely the other Foschini is also going into the mall, so their competitors are also in the mall. If it's not successful, they just both leave. If they both go in and it's both successful, they are happy. If, let's say, they go in and the competitor does not go in, and it is good, they are happy, because remember they only sign like a 5-year lease or a 3-year lease. But the problem comes in if they do not go into a mall and the competitor goes into a mall, and the mall does well, then it's a disaster for them. So they rather just go in And if it does not succeed, they can leave after 3 years, whenever the first lease ends. So it's a very, very quick decision for them. They don't do this whole capital budgeting analysis. So just keep in mind, they can do it theoretically, but in the real world, they don't. But like I said, in a more complex analysis, they will most likely apply. So that is the importance. That is, when do you apply, and what is capital budgeting about? Now we come to where we do the number crunching, the how. So how do you decide regarding whether or not? How do you make the decision whether or not to go ahead with an investment, with a long-term investment? So we apply basically capital budgeting techniques. There are 5 capital budgeting techniques. You need to know all 5, as in know the names of all 5, but you need to really be able to do 4 of them. So in no particular order, the 5 are the net present value method, NPV, the internal rate of return method, IRR, the payback period method, the discounted payback period method, and the modified internal rate of return. The modified internal rate of return, you don't need to know, you just need to know the name that it exists, okay? So out of the 4 that we need to know, NPV, IRR, payback, discounted payback, which ones is the superior and which ones are not the superior ones. So let's start with the payback period and the discounted payback period. What's important to note that the payback period method and the discounted payback period method should not be used as your sole decision-making technique. So you mustn't use that method as your main method to decide regarding an investment analysis. The reason being is there are 2 problems. Number 1, the payback period method does not take into account time value of money. Okay, but now the discounted payback period fixes that problem, because the discounted payback period does take into account time value of money. It is the second reason that's the most important reason. The payback period, as well as a discounted payback period, only takes into account cash flows up until the point you recover your initial costs, your initial investment. So the problem with the payback and the discounted payback period method is that it does not take into account all cash flows. It only takes into account the cash flows up until the point that you recover your initial investment. And that is the reason why you should not use it as your main decision-making method, but you can use it as a reasonability check or just as an additional check. But other than that, you don't use it as your main. If they ask you to use it, then you don't write a letter to the examiner to say you shouldn't be using it. You just do it because they asked you. But if they ask you to make a decision which method, then you must know you should not be using the payback nor the discounted payback as your main decision-making tool. So what are then our main decision-making tools? We have the first 2, NPV, IRR. So we will use those 2 methods. Any of those 2 methods are fine. Why? Because in most cases, the NPV as well as the IRR will give you the same result. What do we mean by the same result? It means it will tell us if IRR says accept, then NPV will also give us the answer or the result, accept. If NPV says reject, IRR will also give the result, reject. So they will generally give you the same result. There are some instances where they give you conflicting results. So the one says accept and the other one says reject. In that case, how do you decide? You will decide based on the NPV method, because the NPV method is the most superior. Why? The reason why the NPV is most superior, it gives you an actual rand value, an actual dollar value. So when the dollar value or the rand value is positive, it means you are making money. When it is negative, you mean you are losing money. So you exactly know whether you are making or whether you are not making money. Whereas the IRR is just giving you a percentage. And there are some reasons when the percentage can be a bit misleading, but that's for another day. So just know that the most superior is NPV. So if NPV and IRR give you conflicting results, you choose based on NPV. But in most cases, NPV and IRR will give you the same result. Now, what are the decision makings? This is the basic rule. For NPV, the rule is as follows. If NPV is greater than zero, greater than zero means positive. So if NPV is greater than zero, if NPV is positive, you accept. If NPV is less than zero, in other words, if NPV is negative, you reject. For IRR, if IRR is greater than WACC, we covered WACC last week. If IRR is greater than WACC, you accept. If IRR is less than WACC, you reject. Why does that make sense? WACC is the cost of finance. So if your return of your investment is more than the cost of finance, you are making money. If your return on investment is less than the cost of finance, then you are losing money. So that's why when IRR is less than WACC, you reject, while when IRR is greater than WACC, you accept. So that's the thinking. So just keep that in mind. Just one last point, that for all of these methods, all five, they are all cash flow methods. That's why they're all appropriate, but some are more superior than the other. Okay, so that's important to note. Do you have any question at this point before I move on to the next point? If you don't, then that's fine. So how do we so this applies now for all methods, okay? Although we're going to be specifically regarding NPV. Just one point that I wanted to mention, that we will always use NPV unless they tell you to use IRR or payback or discounted payback. If they don't specifically ask you for payback, discounted payback, or IRR, you always use NPV. But in most cases, they will tell you which method. And in most cases, like 98% of the time, it's going to be NPV. Even if they ask you for IRR, you'll have to go through the NPV analysis. And then once you have NPV, it'll just be one click of the financial calculator to give you IRR. Okay. So whether it's NPV or IRR, you're always going to do the NPV calculation. Because like I said, with the IRR, there is a specific formula. We're not required to know that. If you're in finance, like investment finance, they require you to be able to calculate IRR with the actual formula and do trial of error. But for our purposes, we use a financial calculator, and hence to get IRR using the financial calculator, you will have to perform the NPV analysis. And once you have NPV, you just press second function button and then you get the IRR. So whether it's IRR or NPV, you must be able to calculate or perform an NPV calculation. So now I'm going to give you the 5 basic principles, the 5 fundamental principles of capital budgeting. So this is for all capital budgeting, although I'll most likely refer to NPV all the time. So in no particular order, what are the 5 capital budgeting fundamentals or principles? Number 1, we are always focused on future differential cash flows. So there's 3 things in this: future differential cash flows. The word future means we're only looking for cash flows that's going to happen. We're not interested in cash flows that has already happened. A cash flow that has already happened is known as a sunk cost. So we don't consider it. Why? Because whether or not you go ahead with a particular investment decision, that cost has already been incurred. So whether you go ahead, you already spent it. Whether you don't go ahead, you also already spent it. It's a sunk cost. It's in the past. So it does not impact your analysis. So therefore, we only focused on future cash flows. Then the third part is that of cash flows. We are only interested in cash flows. We are not interested in non-cash flows. So if they give you a number, but must be on the lookout, especially in costs, in particular in fixed costs. They may included in fixed costs is depreciation. Depreciation is a non-cash flow, so you will have to make an adjustment because we only want cash flows. So we said future and cash flow, so we're missing that middle term, differential, or another term for differential is relevant. An item, an amount is relevant or differential if it will take place only as a result of going ahead with a particular decision. So if you go ahead with a particular decision and that cash flow will take place, and if you do not go ahead with a decision, that cash flow will not take place, then it is relevant because it's only happening as a result of going ahead with a particular decision. So very important. So just to give you an example, let's go back to the Uber driver. Let's say, for argument's sake, the Uber driver needs a parking space, okay, to park his car. Just say, for argument's sake, he doesn't have parking, and so he looks for a parking spot for himself. Okay, so he finds a person that has a spare garage. This person's spare garage have parking for 2 cars, but the Uber driver only has 1 car. The owner of the parking garage says, you can hire this, you can rent out this parking space, but you have to rent out the full garage, which is a space for 2 cars, irrespective whether you have 2 or 1 car. So let's assume the parking cost is 1,000 Rand per month. So the Uber driver is paying 1,000 Rand per month to park his car in a garage that has a space for 2 cars. Now let's say after some time, the Uber driver decides he wants to expand his operations. Okay, so now he takes out a second vehicle. And obviously the second vehicle is also going to need parking space. So now he can use the same garage because he has space for 2 cars. The question would be, when you make an analysis, when you perform a capital budgeting analysis on the second vehicle, do you include the cost of the garage or not? And the answer is you will not include the cost of the garage in your capital budgeting analysis of the second vehicle. Why? Because whether or not the Uber driver takes out a second vehicle or not, he still has to pay parking costs for 2 cars. So whether he has 2 cars or 1 car, he's paying parking costs for 2 cars. So when he takes out the second car, there's no need to include the parking cost of the second car because it is not a differential cash flow. So he is not incurring an additional expense. That expense is already incurred. You must be very careful. They'll throw this quite often without you knowing. So you need to identify whether an amount is relevant or not. The simple rule, the simple principle is, if you're incurring a cost or if you are earning revenue solely as a result of making a decision, then it is relevant. If you go ahead or do not go ahead and you will still incur that cost or still earn that revenue, then that cost or that revenue is not relevant, is not differential, and hence you should not include it in your capital budgeting analysis. So that's the first principle, future differential cash flows or future relevant cash flows. Relevant, differential, same thing, different terminology, okay? The second principle, like I say, no particular order. Okay. The second principle is that of opportunity costs. You must always include opportunity costs in your capital budgeting analysis. Let's use the Uber driver again. So let's say a guy or someone has a spare car and is deciding whether to sell it or to drive Uber. If he decides to go with driving Uber, he has foregone the next best alternative to sell his car. So that is an opportunity cost. He has foregone the next best alternative, and as a result, he has to include that in his capital budgeting analysis. The third aspect is that of the timing of cash flows. The timing of cash flows is extremely, extremely important, and they're going to test you on it, whether you know or do not know. Okay? So, what is the timing of cash flows? So, just to give you some perspective, for Cecil, they are going, let's say they're going to construct a plant. It can take 10, 15 years to construct a plant, and probably only after 15 years, they start generating money. So the timing of cash flow, 15 years into the future, will have a significant impact on the value or the NPV today. So whether a cash flow takes place in year 12 or year 15, that 3-year gap will have a significant impact on the present value today. Also, those capital budgeting analysis is running in the billions. So that 3-year gap, that 3-year difference can have a significant impact on the value today. For us, we're dealing with a 5-7-year project. So when you work out timing of cash flows, you were like, what's the big deal? But we're working with a 5-year period, not a 15, 20-year period. We're working with R1,000,000 or 100,000 Rand, not billions of rands. So therefore, we don't see that significant impact. But in the real world, you're dealing with 15, 20 years, spending billions and billions of dollars. So $15 billion in 15 years' time is very different to $15 billion today. And hence, any like cash flow happening in year 13 versus a cash flow happening in year 15 will have a significant impact. And that is why the timing of cash flows is so important. For our purposes, how do they test the timing of cash flows? By determining in which column do you put a cash flow in. Do you put a cash flow in the correct column, year 1, year 2, year 3, year 4, or year 0? Now, to get it right, you need to know what does each column represent. Column 1, year 1, represents the end of year 1. Column 2, year 2, represents the end of year 2. Year 3, the end of year 3, and so on. Therefore, if a cash flow happens at the end of year 2, you can put it into the column year 2. If a cash flow happened at the beginning of year 2, you can't put it into year 2. You can't put it in the column of year 2 because the column of year 2 represents the end of year 2. So where do you put it then? So something that happens at the beginning of year 2 will be put into the column year 1 because the end of year 1 is the same thing as the beginning of year 2. So very, very important. That is why the cost of the investment happen in year 0, because you have to incur the cost of the investment at the beginning of year 1. Because it's happening at the beginning of year 1, you can't put it into year 1 because year 1 represents the end of year 1. So where do you put it? The column before, which is year 0. And why does that make sense? For the Uber driver to make money or to start driving, he first needs the vehicle. So he needs the vehicle at the beginning of the year, let's say year or period. in order to generate his money. And therefore, it's safe to assume that we need it at the beginning of year one, but we can't put it into year one because year one represents the end of year one. So therefore, we put it into year zero. So that was future differential cash flows, opportunity costs, timing of cash flows. Number four, like I said, there's no particular order. Don't have to memorize the order. Number four is all cash flows needs to be after tax. That is why the last line will be tax, because we need to analyze an after-tax number. So one reason is, like the typical way of understanding the purpose of a business, this is the old school way, the traditional way, that the purpose of a business is to generate wealth for the shareholders. Now, the shareholders' wealth is based on after-tax cash flows, and hence we need to determine after-tax. Because remember, you want to determine, are you creating wealth for the business? Now, every business have a silent partner. That silent partner is SARS. So you first want to give your silent partner's percentage, and then you want to see, are you creating wealth for what's remaining in your business? Okay, so that is why it's after tax. Another reason also, for example, in mining, tax on its own can make an investment viable. So without the nice tax rules, some investments will not be beneficial, will not be viable, and hence you won't go ahead. But if you consider the tax impact, then it does become viable, and hence you will go ahead with it. So there's various reasons, but keep in mind you must always the capital budgeting must always be after tax cash flows. But we just have one line for tax. The fifth, which is the last one, is that you must not mix financing with investing cash flows. So, for example, in your capital budgeting calculation, where you put in all your cash flows, you should not have finance costs, because finance costs is relating to a financing decision, and we are busy with an investing decision. The second reason is finance costs is already taken into account in your discount rate. So remember, we have column 1, 2, 3, 4, 5, or for whatever a number of columns, and those are future cash flows. We're going to present value those future cash flows to today, the present value. In order to present value future cash flows to today, you need an appropriate discount rate. Now, included in that discount rate is the cost of finance. And hence, if you include the cost of finance in your cash flows, you'll be double counting. So that is why do not include financing cash flows in your capital budgeting calculation. So those are the 5 basic principles. They will test you left, right, and center on it, whether you pick it up or do not pick it up. So just make sure you let those capital budgeting rules or principles or fundamentals sink in. Okay. Now we're going to do 2 further aspects, and then we'll go into the question. Number 1 is how to deal with an unequal useful life, and number 2 is how to deal with capital rationing. So to dealing with unequal useful life. So when you're comparing 2 projects, a project with a 5-year useful life versus a project with a 7-year useful life. Typically, we have 2 projects with the same useful life, and we make a decision based on NPV. The one with the highest NPV, that is the one we accept. But when it comes to 2 projects that have different useful lives, you cannot base it on NPV because you're not comparing apples with apples. The 2 projects are not comparable. So we need a technique in order to make them comparable. So the technique we use is known as the equivalent annual annuity. The equivalent annual annuity, what does that do? It converts the total NPV into an NPV per annum. So now we're comparing like for like, NPV per annum versus NPV per annum. So now you can decide which project is the most viable, and you'll choose a project with the highest NPV per annum. There's a formula on the website where we discuss that. The last aspect is that of capital rationing. What is capital rationing? Capital rationing exists when there is a limit on how much you can spend on investment projects, on capital expenditure. Every company set budgets. Every company will have a budget on how much you can spend on long-term investments. They will call it capital expenditure. So when you have that budget, so capital rationing will come into play when two conditions are satisfied. Number one, if there is a budget, there is a capital budget. And number two, the cost of all the projects that you want to invest into, that costs exceed the capital budget. So let's assume you have 10 projects. Out of the 10 projects, there are 8 projects that have a positive NPV. So you would like to invest into all of those 8. You're not going to invest into all 10 because 2 of them have a negative NPV, while 8 of them have a positive NPV. We are only interested in projects with a positive NPV because those are the projects that will generate wealth for the business, whereas the one with a negative NPV will destroy value. So we are interested with that 8. So we would like to invest in all 8. However, when we work out the cost of all 8, it comes to, let's say, 1.5 million, yet the capital expenditure budget is only 1.2 million. So now you can't invest in all. So you're going to have to choose. The way you choose is by using the profitability index. The profitability index ranks projects from highest to lowest, and you will select the project from highest up until you get to the lowest, up until, so you'll select from the highest and go down up until your capital budget is exhausted. There's no more funds available. Once again, the profitability index is on the platform. You can see the formula and all of those type of stuff. Okay, so we're going to go into the question now. But before we go into the question, do you have any questions for me? If not, we will go on to the, I'm just opening up Excel in the meantime. We will go to this, we will go to the scenario. No, so we don't take financing cash flows into account. The reason being is it is taken into account via the discount rate. Okay, I'm going to share my screen now. If you have any questions, you can ask me. I check the chat regularly. So remember, next week there won't be any class because we're doing I'm doing a 1 week revision for test 1 for the CTA guys. We will resume the following week. From the following week, I'm going to do what I'm doing with the CTA guys. We're going to give you some work to do in class. So just to get you involved and to actually start making getting your to start thinking, and then you can actually pick up if there's any issues that you have. So just to make it so I can actually see where people are doing well, where people are maybe struggling, and so forth. So in 2 weeks' time, we're going to start giving you the answer part, and then I go through it. So I'll give you like 5-10 minutes, just an aspect, and then I go through it with you. And in that way, we get much more engagement because you actually get involved with the actual answering of the question. But for now, I'm going to share my screen. I'm going to go on to, so you should have MAC 3702, October, November 2019. I'm not going to read the full scenario. Just going to read the part of capital budgeting. I'm just going to read the this first page with maybe some background information just to give us an idea of what the company is about. And there may be some information that we may have to use. We don't know. And then once I'm done here, we will go straight to the section of capital budgeting, and then we'll read that part of the scenario and then answer the question. So they say Eskom is a South African electricity public utility established in 1923 by the South African government. Eskom, Africa's largest producer of electricity, generates approximately 95% of electricity used in South Africa. The company has three major operating divisions, namely generation, transmission, and distribution. 40% of the company's electricity is sold to distributors, metros, and municipalities, which in turn sell to their residents. 46% to commerce, industry, and mining sectors, and 7% to independent households, and another 7% to international utilities. So they're just trying to show you how the electricity that they generate, how is it distributed? Okay, so it's distributed between four different sectors. To ensure that Eskom meets the expected demand, it also buys up to 10% of its electricity from independent power producers. The company's electricity is mainly generated from its coal-fired power stations, although there are a few gas liquid, fuel turbine stations, and one nuclear plant in Koeberg, Cape Town. Eskom has applied to the National Energy Regulator of South Africa to increase its tariffs by an additional 45% over the next 3 years. This is an attempt to get the company out of its cash flow insolvency position. The company's financial performance has been plagued by high levels of foreign denominated debt, aging infrastructure, poor debt collection processes, frequent changes to the company's board of directors, and political interference. A new company CEO, Fakama Radebe, was appointed a few months ago, and she has been tasked with implementing the turnaround strategy to salvage the company. However, this appointment came at a time when there had been widespread public outcry to have the utility privatized. In an effort to curb inflation, it is highly probable that NERSA will only allow an increase in electricity tariffs of 5% per annum for the next 10 years. Okay, so take note of that. The company wants 45% of the next 3 years, but what's happening based on what did they say? Or the estimated guidelines, that will most likely only be 5% per annum for the next 10 years. The management of Eskom has come under fire following huge project cost overruns at 2 of its power stations, Kusasa still under construction and Medupi operating at 20% of full capacity. These 2 power stations have been cited as the major cause of current outages experienced throughout the country. The Medupi power station was only brought into operation just after Fakama Radebe's appointment as the chief executive. You are part of the task team that has been appointed by the President and the National Assembly to assess, among other factors, the viability and financial performance of Eskom, the viability of the 2 projects, the possibility of privatization of the entity, the financing options, as well as the restructuring of the company's operations. The financial statements of Eskom are presented below. I'm not going to go through the financial statements. These are all the notes to the financial statements. You will need this for the WACC question and the financial analysis. And the WACC, and you'll need the financial statements for the WACC as well as for the I don't remember what's the other thing, for financial analysis. So here we go, the future of Kusasa Power Station. So they say China Power Investment Corporation has offered 300 billion rand to buy the Kusasa plant from Eskom. Tax implications on this disposal to CIPC should be ignored. CPIC, which is China Power Investment Corporation, plans to complete the construction of this plant and then sell electricity generated from this plant to some SADC countries and eventually to Eskom should there be an increased demand in the near future. So what this question is going to do is basically you have to decide whether Eskom should complete its construction or whether Eskom should sell it to China. We know if they sell it to China, they will get 300 billion. We need to see whether they complete the construction, so meaning whether they keep the, So we need to see whether if they keep the plant, whether they will generate more than 300 billion. So basically it is simple. The decision is as this: do we sell it off or do we keep? If we sell it, we're going to get 300 billion. If we keep it, that is what we need to determine how much we're going to generate. They say to date, the Kusasa plant has already cost Eskom 220 billion, which is the carrying value and the tax base. So this has already been incurred. So this is a sunk cost. So we should not include it in our capital budgeting question. I would include it as a line item and show it as 0 and say it is sunk. Remember, in finance, this is for both MAC as well as financial management. You have to comment on each number. So if you use a number, they understand what you're doing with it. If you don't use a number, you must tell them why you're not using it. So over here, we're gonna put in the 200 billion, and then we're gonna say it's gonna be 0. Why? Because it's a sunk cost. The South African government does anticipate increase in demand for electricity and is not very keen on selling this unit. However, fiscal challenges, slow economic growth, and poor cost containment measures have left the cabinet divided on the best way forward for the utility company and the nation as a whole. To continue with the Kusasa project, Eskom will require an additional 80 billion for the next 2 years, spent in equal installments at the end of each year. So that's a future cost, so we'll have to take that into account. If the decision is to complete the construction of Kusasa, the company will likely sell the plant in 6 years' time for a maximum amount of 40 billion rand. Okay, so that we call the realizable value or the scrap value. That will happen at the end of the useful life. So they say in 6 years' time, so that must indicate to you that this project is most likely a 6-year project. So you're going to have your columns is going to be up until year 6. At full capacity, Kusasa is expected to generate and sell electricity of 100,000 gigawatts per year. The plant, however, will start generating electricity at 60% of capacity after it is brought into operation at the end of the first year. Thereafter, the generation will increase by 20% per annum. The operating costs per kilowatt is expected to be 32 cents, and this will be fixed for the next 6 years. Okay, so there you can see the 6-year project. Your revenue is 60% in year one, and then will increase by 20% thereafter. Remember, full capacity is 1,000 gigawatts. 100,000 gigawatts. The next important thing to note, this 32 cents is 32 cents. Where did I see that now? The operating cost of 32 cents is based on kilowatt, and they're giving us gigawatts. So there's going to be a conversion. We need to see, someone can just have a look how to convert kilowatts to gigawatts or gigawatts to kilowatts. I think probably 1,000 or a million, I don't know. Over and above the operating costs, Eskom will also pay a project management fee to a French company of 800,000 euros per month once the plant starts generating electricity. Revenue per kilowatt as per regulations currently averages 75.60 per kilowatt. The revenue per kilowatt increases as per NERSA estimate guidelines. Okay, the word currently means now, so we have to increase it from year one. So here they say revenue per kilowatt as per regulations currently refers to now, is 75.60. We need to work from year one. So from year one, the price is going to be 75.60 times 5%. So because pricing is given per kilowatt, we will convert the units from gigawatt to kilowatt. The South African Revenue Services grants a capital allowance of 20% per annum on power stations and on all electricity equipment and on all electricity equipment used once an asset has been brought into use. The allowance is granted on amounts already incurred and paid. Very important sentence. We are still going to incur 80 million, but we have already incurred 220 billion. So, sorry, we're going to incur 80 billion and we have already incurred 220 billion. SARS grants a deduction for both that we're going to incur as well as what we have incurred, as long as the plant has been brought into use. So two conditions must hold to get the 20% deduction. Number one, the plant is brought into use, and number two, you have already incurred the costs. Okay, so that's very, very important to take note. Okay, so that's all over there. Let's just see under the additional information. We're not going to do the financing. Additional information. Eskom Treasury Department forecast exchange rate to be that. Okay. The Eskom uses the weighted average cost of capital to discount cash flows, taking in at least 1 year. The company's South African income tax rate is 8%. Eskom operates with 365. Okay, so we're happy with that. Let's see what questions. We will deal with that now. We will deal with the 5. When we go through the question, I'll answer that 5%. Do you have any other questions? I'm going to go on to the. I'm going to go on to what you call it. You should see Excel. Do you see Excel? Okay. So let's have a look at this question. So it's going to be details. So we have details. We have year 0. Then we have the number of years. It's 6 years. So it's year 1, year 2, year 3, year 4, year 5, and year 6. Okay. Your typical line items will be cost of investment. We know here's a cost of investment. Okay. I'm just going to have I'm just going to have a column called comments. So then we will tell the examiner certain things. We will have things like revenue, okay, and then you will have variable costs, fixed costs. So I'll just show you a general template. This is a general template. It's not fixed in stone. Okay, so I'll show you a general template that you can use for your just to get a start. I'm just going to use a 5-year. Let's just use a 5-year period. So a general template will look as follows. So cost of investment, you will have revenue, you will have variable cost, you will have fixed cost. And remember, in fixed cost, just take note if there's any non-cash flow, you could have maintenance costs. And why I put maintenance costs separate, you can include it in any other costs, but generally it's showed separate. So I just show it separate. Then you could have a realizable value. Remember, the realizable value is the amount that you will sell the asset at the end of its useful life, also known as a scrap value. You could have an opportunity cost. You could have an opportunity cost. You could have working capital. These are typical examples. And then tax. Okay, so that is how it will look. Tax, you generally have a separate calculation. This will give you net cash flows. This will give you net cash flows. So generally cost of investment will take place over there. Revenue, cost of investment is an outflow. So we put it inside of brackets. Then you would have revenue, which is an inflow. So it will be year 1 up until year 5. Then you will have outflows. Variable cost is an outflow, so it's inside of brackets from year 1 to year 5. And then we have same for fixed costs, same for maintenance costs. Okay, the realizable value will happen at the end of the useful life, and it's an inflow because you're making money. An opportunity cost will generally can be anywhere, but it's generally the opportunity cost is now because you're going ahead with the investment now, but you could have sold. You could the next best alternative was you could have sold your Uber car now, so you're losing out on whatever you could have sold the Uber car for. So general opportunity cost is negative. Working capital. Working capital is generally an outflow in year 0 and then an inflow at the end of the useful life. Okay. So if they don't tell you when working capital takes place, you assume it takes place immediately, because think about it. For Pick n Pay to operate, they need groceries. Groceries is their working capital. Groceries is their inventory. Inventory is working capital. In order for them to make sales to you, they need the inventory. So therefore, they will need it up front. So when they don't tell you when working capital takes place, you will assume it's happening immediately. So meaning at the beginning of year 1, that's why we put it into year 0. And then as you work through at the end of the useful life of the project, you will make your money back from working capital. And that is why we have, so let's say it's 100,000 negative, it will be 100,000 positive over here. The reason why we're showing it, although the net effect is 0, is due to the time value of money. 100,000 Rand today is very different from 100,000 in 5 years' time. Therefore, we need to show the inflow and then the outflow at the end of the project term. So just take note of that. Then we have tax. Tax will generally be an outflow. You do a separate calculation for tax. And then this will give you your net cash flows, okay? So this will give you your net cash flows. So these are all your future cash flows. Your net cash flows are your future cash flows, but you want a present value. You want a value today. So we get the NPV today by using an appropriate discount rate. The appropriate discount rate for an investment decision, the appropriate discount rate for a capital budgeting question is always WACC. And once we use the appropriate discount rate, we will get NPV, and that is what we are looking for. So the same thinking in this scenario. So the same thinking in this scenario. So that's just basically a general template. Now we go over here. We have cost of investment. We have revenue. Then we have variable costs, which is the cost per kilowatt. So just say cost per kilowatt. You can call it whatever you want to call it. Let's just see what did they call it. If I go back up, what did they call it? Where's the 32 cents? Operating costs. So we can call it operating costs. So we're going to say operating costs. Then there is a management fee expense. A management fee expense. So if you have a look at their full capacity, they talk about revenue. So we got revenue. Then they talk about operating costs. Then they talk about the management fee. Remember, right on top, they made mention of a realizable value. So we can bring the realizable value in. And I don't know if there's anything else. I don't know if I missed anything else. So I leave a space just in case. And then I put in tax. This will give me my net cash flows. So remember that this is cash flows. So why I say net? Because it's revenue less costs. Okay, so it's income versus what we just call it a net figure. Then we have a discount rate. Now the discount rate, they say the company uses the WACC. We were required to calculate WACC in the previous part. So they say the company uses the WACC to discount cash flows taking place in at least 1 year's time. So we don't have the WACC because we're supposed to calculate it in the previous question. So we're going to have to make up a WACC rate. So I'll just make up one. So I can't remember the answer. And then that's going to give us NPV. So in your exam, you will have to take whatever WACC rate you came up with. NPV. Okay, so whatever WACC rate you came up with in your exam, you will have to use. So let's quickly go look at the required. So you can just understand the required. So look at number 3, required 3. Advise the management of Eskom whether they should continue with the construction of Kusasa Power Station. Show all your calculations. So here you are helping management make a decision regarding a long-term investment. So you have to advise them. Okay, so that's helping them making a decision regarding what? Regarding the Kusasa Power Station. The Kusasa Power Station is an investment, a project that generates cash flows over a period longer than 12 months. So therefore, it is a long-term investment. So that brings you into the domain of capital budgeting. Okay, that is why we know we must use capital budgeting over there. So let's have a look at the cost of the investment. They said, remember, generally a cost of investment happens in year 0. But over here, they told us, so let's see, it could be something. So over here, they said to continue the Kusasa project, Eskom will require an additional 80 billion for the next 2 years, spent in equal installments at the end of each year, not at the beginning of each year. If it was at the beginning of each year, then that means it was the beginning of year one and the beginning of year two. In that case, the first 40 billion goes in year zero and the second 40 billion goes in year one. But now in this scenario, we are spending the amount at the end of each year, the end of year one, the end of year two. So therefore, the first 40 billion goes into year one, and the second 40 billion goes into year two. Here they are testing the timing of cash flows. They know many students expect the they know many students expect the cost of the investment to happen into year zero. So here they're testing whether you know the concept of the timing of cash flows. So here we're not going to put into year zero, but rather in year one and in year two. So if I go over here, in year one, I'm going to put in 40 billion. I'm making it negative. The reason being is it is an outflow. So negative 40 billion. 1, 2, 3, that's 40,000. 1, 2, 3, that's 40 million. 1, 2, 3, that's 40 billion. Okay, so we're happy with that. The next 40 billion will happen in year two. Then I'm going to give them a comment. I'm going to say that the 220 billion already spent is not taken into account. Why? Because it is a sunk cost. I'm writing a full sentence because for your explanation, you can just say the 220 sunk costs. Therefore, simple, the 220 sunk costs, they will understand that you mean you're not including it. Okay, I'm writing a full sentence because you're most likely going to use this when you go through it again. So very important, they in that cost of the investment, they tested two of the fundamental principles. One, timing of cash flows. We usually expect the cost of the investment to happen in year zero. But here they told you that we're gonna spend a further 80 billion that will happen over 2 years, and it's going to happen at the end of each year. So therefore, firstly, the 80 billion does not go into year zero, but rather the 80 billion must be split into two, 40, 40, and it's going into year one and year two. Why? It's happening at the end of each year. If this had to happen at the beginning of each year, then you would have year zero and year one. Please take note of that. The second principle is that we only focus on future differential cash flows. The 220 is not a future cash flow. It is a past cash flow. It is a sunk cost. So therefore, we don't include it. In the first line, they tested two principles already. Now we're going to do revenue. Now we're going to do revenue. So I'm going to have my workings over here. Okay, so I'm going to have working one. So let's have a look at working one. So what is the revenue? The revenue is kilowatts times price times kilowatts times price per kilowatt times percentage increase. Okay. So I will just bring it in over here. Revenue only happens from year one. Remember, year zero represents now, the beginning of year one. You're not going to make all your revenue now. You're making it throughout the year. We assume that anything happening throughout the year happens at the end of the year. For example, the Uber driver, he does not make his money all on the 31st of December, but rather he makes it from 1 January up until 31 December. But we assume everything happens at the end of the year. Why? Just to make it simple. If you had to make it every day for each column, for year one, you would need 365 columns. For year two, you will need 365 columns. So if you must think about that, and Eskom must do a 20-year analysis, and each thing is 365, the thing will be a shambles because there's just too many columns to work with. So to simplify things, we make a year one column, and we just assume all cash flows, even though it happens throughout the year, takes place at the end of the year. That is totally okay because we are applying the same principle for every single year. So that won't have a significant impact by having it on day one versus on having on day 365. So just keep that in mind. So because revenue is happening from the beginning of the year up until the end of the year, we assume it's happening at the end of the year. That is why we start with revenue and costs from year one. So the first thing would be kilowatts, kilowatt per hour, something like that. Then it's going to be rate per kilowatt, whatever, and then it is increase, percentage increase. Okay, percentage increase. Now I'm just going to say rate per kilowatt. So I have to think quickly. Okay, so that's fine. So remember, it is 100,000 gigawatts. So this is equal to 100,000 gigawatts. We need to find out how many kilowatts in a gigawatt. So I don't know. I'm going to Google. So how many kilowatts in 1 gigawatt? How many? Okay, let's just see if I did it right. What is that? 1 million. 1, 2, 3. 1, 2, 3. 1, 2, 3. Okay, so 1 million kilowatt in 1 gigawatt. Okay. How do you know that? I don't know. I wouldn't have known. I'd have just made an assumption. Times 1 million. 1, 2, 3. 1, 2, 3. So at full capacity, we have 100 million kilowatt hours. Okay, so the amount of electricity at full capacity is 100 million kilowatts. But we know in year one we only have 60%. Okay, so we only have 60%, so it is 60 million kilowatts in year one. Full capacity, 100 million kilowatts. They said year one is only up to 60% capacity, so therefore we multiply by 60%. So that gives us the amount of kilowatts for year one. Then they told us currently meaning year zero, the price is 75, what was it? 75.60 cents. Okay, so the price is 75.60 cents. I want to convert it to rands, so I divide it by 100. So the current price is that. That's the current price. So that's the current price. Okay. We don't want the current price. We want the price of year one. So therefore, we must multiply it by 1.05, taking into account the 5% increase. That's very important. If they told you the price next year, the price in year one is 75.60, then we don't apply the increase. But because they said, according to regulations, currently, the price is 75.60. Currently represents now. Now is year zero. We busy with year one. So therefore we apply the 5% increase in year one already. So each year we can apply the 5% increase. So I'm going to say that multiplied by 1.05. Last year's price multiplied by 1.05, which will give me, so I'm just going to drag it across. Okay, I hope you get that. Then over here, each year it's going to increase by 20%. So all I can do is say that year 1's kilowatts and multiplied by 1.2, it is 20%. And I can just drag it across. Okay, but have a look at year 4 and have a look at year 5. What do we notice? Year 4 and year 5 and year 6 exceeds the full capacity. We can't, although we get increased by 20%, we can only increase at 20% until we reach full capacity. Full capacity is 100 million. So therefore, we're going to have to limit this to 100 million. Oh, not 100 million. So we have to limit it to 100 million. And I'll just let them know. I'll tell them years 4 to 6 exceeded the maximum capacity. Exceeded the maximum capacity and therefore limited it to max capacity. Many people missed that. Many people missed that. They just ran through. So just be aware. So therefore, revenue is equal to, so for those who can use Excel, you were lucky. For those who didn't use Excel, who was better at using, who prefers writing, obviously there was lots of calculation. And that is why it's 15 marks. It's a lot of marks, yet not a lot of stuff to do because there's lots of this kind of calculation. Okay, I had a question. So, I don't know. So in the scenario, right on top in the, so right on top in the, let me just show you quickly, in the background information. In the background information, yeah. Yeah. So there's the 5%. Okay, so they're saying in an effort to curb inflation, it is highly probable that NERSA will only allow an increase in electricity tariffs of 5%. So in an exam, you highlight all numbers, okay? Whether they put the number in words, in text, or whether they put the numbers in a number format. Okay. So just be aware of that. So now I will just go to this to over here. I'm going to fetch it. I'm going to say equal to that. By the way, I just work in full numbers because I don't know about you, but I easily get confused when I must have to work in what you call it, either in rand millions or rand thousands. They give numbers in such different ways that it's just much easier to use full numbers. I'm rather going to write extra zeros than to get extra zeros than to get zero for my mark. Now I'm going to do operating costs. As you can see, I referenced. So make sure you also reference. So let's do operating costs. So operating cost is working 2. If we have a look at the operating costs, if I have a look at the operating costs, where is that now? So the operating costs, they said operating costs per kilowatt is expected to be 32 cents, and this will be fixed for the next 6 years. So that's easy. If we go here to operating costs, we apply the same format. So we apply the same format. I'm just going to bring it in, copy and paste. The kilowatts remain the same. Okay, your variable cost is relative to output. So output, our kilowatts remain the same, but this we're going to call operating costs. And then this we're going to say is equal to 32 divided by 100, 32 cents, and it remains the same. There's no increase. So that is 32, whatever that is. So I'll just go fetch that as well. It's a cost, it's an outflow, so I'll make it negative. It's a cost, it's an outflow, so I'll make it negative. And then I'll just drag that across. And we go to working 2. Then the management fee, if I go have a look at the management fee, if I go have a look at the management fee is 800,000 euros. And then somewhere right at the bottom, they said, here's the exchange rates. So they gave you a closing and an average. You use a closing if it's an asset or a liability. You use the average if it's an income or an expense. Because the management fee expense, we're going to use the average column. Okay, so I'm going to do a copy that also, working 3. I'm going to copy this as well. But now, this I'm going to change to management fee. This I'm going to say average exchange rate. Remember, they said over here, it is 800,000 and it's going to remain at 800,000. So they say over and above, okay, Eskom will also pay a project management fee of 800,000 per month once a plant starts generating electricity. Okay, so once a plant starts generating electricity, which is from year 1, so it's going to be equal to 800,000 euros. 800, 1, 2, 3. It is per month. So, and we work on an annual basis, so we multiply by 12. And then I just drag that across. So each year remains the same, but in euros. Now I need to get the average exchange rate. The average exchange rate using that exchange rate. Now you can see the exchange rate is not working out nicely. So I'm going to convert it into, so this is 1 ZAR per euro. I'm going to convert it into 1 euro, 1 euro per ZAR. So it's 0.063, 0.063. So this is equal to 1 divided by 0.063. So that is more an exchange rate. So remember, you must apply reasonability. They said 0.063. You know 1 ZAR is not 0.063. It's more or less around here. Can someone just help me with the numbers? So it's equal to 1 divided by 0.60. What's the next one? Anyone?
The next one is 0.56.
Sorry, but this one here, 0. I think I got it wrong.
56.
Number 2 is 1, 0.60. 0. No, something not right. Isn't it 0.060 like that?
Yeah,
Okay.
0.60.
Yeah, that makes more sense. Then
Yeah.
equal to 1 divided by what?
0.056.
56. Then over here, I think 4, 5, and 6 is the same, right?
Yeah, it's the same.
Why? Okay, what is it?
So 0.054.
Okay. Now I'll just drag that. Okay, so that is my cost over there. Management fee equal as a fee is an outflow, so therefore it is negative. And I'll just drag this across. Here I'm going to put in working 3. My realizable value, they gave it to me at 40 billion. But remember, a realizable value happened at the end of the useful life. So it's the end of year 4. So I'm going to say 40, 1, 2, 3. That is 40,000. 1, 2, 3, that's 40 million. 1, 2, 3, that's 40 billion. It's an inflow, because you're going to sell it, so you're going to make money. So before I go on to tax, let's just go through the workings over here. In working number 1, we did revenue. We said that the full capacity is it was 100,000 gigawatts. We converted it to kilowatts. So it gave us 100 million or something, or 100 billion, whatever it was. Okay. And then each year, but in year 1, we only had 60%. We only reached 60% capacity. So therefore we multiplied it by 60%. Then thereafter it grows by 20%. So we grew it by 20%. But in year 4, 5, and 6, by growing by 20%, resulted in the capacity being exceeded. So therefore, although you're growing by 20% per annum, you can only grow up until you reach full capacity, because you don't have beyond full capacity. So therefore, you have to cap it at 100,000 in year 4, 5, and 6. Then for the rate was given to us at 75.60 cents, so we needed to convert it into rands. And another important aspect, they gave us the rate, the current rate, which is the rate in year 0. We needed the rate for year 1, so therefore we applied the increase from year 1 onwards. If they gave us the year 1 rate, then we only apply the increase from year 2. Please take note of that. Then for operating costs, working 2, the kilowatts remain the same. It is a variable cost. So therefore, variable cost fluctuates relative to output. The output was what we calculated in year 1, in working 1. The costs remain the same at 32 cents, but we needed to convert it into rands. So therefore, we said divided by 100. Then we come to the management fee. The management fee was a fixed amount of 800,000 euros per month. So you must not use 800,000, but rather 800,000 times 12, because we need to get an annual figure. So that gave us the 9.6 million euros. Then we need to convert it into rands. So we needed an exchange rate for every 1 euro, how many rands? They gave us for every 1 ZAR, how many euros? So therefore, we needed to convert it somehow. So I rather convert the exchange rate into a euro per ZAR. And therefore, I went and said 1 divided by to give me what the euro amount is, and that looks reasonable. And then obviously applied, and that gives me my cost. Remember, a cost is an outflow, so therefore I show it as negative. An inflow, revenue, therefore it is positive. Realizable value happened at the end of the period, and it's an inflow, so therefore it is positive. Now we're going to do tax. So in working 4, we'll do the tax calculation. So in here, working 4, we do the tax calculation. So the way you do the tax calculation is by going through your cash flow your cash flow analysis. So you have a look through each line item. You have a look cost of investment. Does it have a tax implication? The answer is yes. Okay, so cost of investment does have a tax implication through the wear and tear allowance. Revenue, does it have a tax implication? The answer is yes. We all know that. Operating cost, it has a tax implication. Management fee expense, it has a tax implication. Realizable value, it has a tax implication. If you had opportunity costs, an opportunity cost usually have a tax implication. So the silence, you can assume that there is. Working capital does not have a tax implication. So even if you have working capital in your calculation, you do not include it in your tax calculation because there's no tax impact for working capital. So I'll just copy all of those and bring it in over here. Instead of calling it cost of investment, I'm going to call it wear and tear allowance. Okay, I'm going to have 2 separate wear and tear allowances, and I'll tell you why now. Remember, SARS allow a 20% allowance per annum. Okay, so they allow a 20% allowance per annum on the cost of the investment. So this 40 million, there will be a 20% from year 1 onwards for 5 years. That 40 billion will have a 20% allowance for 5 years. So please please be aware of that. So over here, for the wear and tear allowance, a wear and tear allowance reduces your taxable income, so therefore will be negative. So in year 1, we're going to have 40 billion, 1, 2, 3. I just want to go fetch that number. Oh man, anyway, so equal to 40 billion, 1, 2, 3, that's 40,000, 1, 2, 3, that's 40 million, 1, 2, 3, that's 40 billion. So from year 1, I'm going to get 20%. But only, so 20% divided by 100 gives me 5 years. So I can drag it for 5 years. Okay. Then I'm going to show the second one. I'm just showing it separately. You can do it together, hey? I just, for ease of my brain, I need to show the second one separate. Then the second one only starts in year 2. Because remember, in order to get the allowance, you must have brought the item into use. So the plant has been brought into use from year 1. But that's the first criteria. The second criteria, you must have incurred the expenditure. So the first 40 billion was incurred from year 1. The second 40 billion was only incurred from year 2. Therefore, you can only apply it from year 2. Once again, the timing of cash flows. So equal to negative 40. 1, 2, 3, that's 40,000. 1, 2, 3, that's 40 million. 1, 2, 3, that's 40 billion, multiplied by 20%. 20% gives you 5 years. So I drag it up until year 6. So if I add them up, it should add up to 40 billion. It mustn't exceed 40 billion. So I'm not going to grant you a reduction more than that. So that adds up to 40 billion. If I add up, it adds up to 40 billion. So I'm happy. Let me just add in another wear and tear. Remember, wear and tear relating to the sunk costs. So if you read the last sentence by the tax implication, they say SARS grants you a deduction for all amounts that is going to be incurred as well as those that have already been incurred. We have already incurred the 220. But why haven't the 220 been allowed as a deduction previously? Because the plant was not yet brought into use. The plant only got brought into use in year 1. So only from year 1 in this, what you call it, that we can start getting the deduction. So from here, SARS will give us the deduction on the 220 from year 1. So equal 220, 1, 2, 3, that's 1,000, 1, 2, 3, that's million, 1, 2, 3, that's billion, multiplied by 20%. So also until year 5. I'm just showing it separately. You can do it all together. It's your choice, no problem. Okay. Then I can just bring in all the other amounts as is. So I'm just going to copy them as is. So I'll just copy them as revenue increases taxable income. Operating costs decreases taxable income. Management fee decreases taxable income. And realizable value increases taxable income. So now I can do that. And this is now taxable income. But now remember, we don't want taxable income. We want tax. So now we say tax at 28%. So equal to that multiplied by 28%. So I just drag it across. So as you can see, in year 1, we made a taxable loss. In year 2, taxable loss. In year 3, taxable loss. In year 4, taxable loss. In year 5, taxable income. In year 6, taxable income. So a loss means we get a tax deduction. So therefore, we have a tax loss over here. So that is a positive impact on the cash flow, on the capital budgeting. That's a negative, is a positive impact on capital budgeting. When you make a taxable income, you have to pay SARS money. So therefore, that will be an outflow. So when you bring your tax across, you need to change the sign. So I'm going to say equal, negative changes the sign. So I want that to be positive. Why? I made a tax loss. So a tax loss is a positive impact on, is effectively acting as an inflow to our capital budgeting analysis. Whereas from year 5, I made a taxable income. So I expect to pay SARS money, which results in an outflow. So that's why it's negative. Year 6 was also taxable income. So I need to pay SARS money, and that's that. So just be aware of that. So now if I add up my cash flows, I will get whatever this is. So these are my future cash flows. But I want a value today. I want NPV today. In order to get NPV today, in order to get the value today, I need to present value my future, I need to discount my future cash flows using an appropriate discount rate. The appropriate discount rate for a capital budgeting question for an investment analysis is the weighted average cost of capital. The weighted average cost of capital was not given. We had to calculate it in a previous question. I can't remember the answer, so I'm going to make up a number. Please note, this is not the answer to the previous part, I think part 2. This is a made up number, so I'm going to make up, just call it 15%. So if I use a whack made up number of 15%, I'm going to highlight it in orange because it's made up. You must use whatever you calculated in your previous question, and we're going to say equal NPV. So using the financial calculator, they want the rate. Using Excel, they want the rate. Then they want value 1. They want value 2. They want value 3. They want value 4. They want value 5. And they want value 6. And this gives us $132 billion Rand. So as you can see, well, I don't know if the answer is right, but obviously I don't know which the rate or what rate they actually use. But assuming the 15% is correct, we compare this 132 billion to the 300 billion that China want to give us. So we will say, in actual fact, the China 300 billion is far more better or beneficial from a numbers perspective compared to this 132. So rather, let us use, let us sell it to China. That's purely from a numbers perspective. Obviously, in the real world, we have to consider other qualitative factors. Okay, so that's all from my side. Do you guys have any questions? Remember, this 132 is not necessarily correct because we don't know what the discount rate is. No. Okay, so in reality, SARS is not going to give you the physical cash. However, what happens is you have a project. So this project of Kusasa project is a very closely linked to the normal business of Eskom, right? So the loss on the Kusasa project will be offset against other income from the general business or other projects that's happening. So therefore, we include it because we will be able to benefit from it in year 1 by using that loss from this project in the normal business of Eskom against any taxable income that they have. SARS don't physically pay back a tax loss. SARS says a tax loss will be offset against future taxable income. But remember, in this scenario, this is one project out of a bigger business. So the loss on this tax loss on this project will be offset against other income in the rest of the business. They did not tell us anything otherwise, so we assume that. Remember, the new legislation regarding a tax loss is that SARS only allows a tax loss for 3 years. After that, it falls away. I'm not sure if it came into effect yet, or it did already come into effect, but it was passed, but it only come into effect in the next year or 2. So that's all from my side. Do you guys have any questions? If you don't have any questions, then answer 2 questions for me. I'm going to go through each one of you. So as I call out your name, you can ask me any question you have specifically, but if you don't, you can answer 2 questions. Number 1, what did you learn in this lesson? And number 2, is there anything still confusing regarding capital budgeting? So I'll give you 1 minute to think about it, and then I will call out whatever name I'll randomly call out. I know some people don't like to, like in the CTA, not everybody likes to speak, then you can type it out, but preferably try to speak if you don't mind. Okay, Fahim, we'll go with you. If you have any specific questions, you can ask me. If you don't have, then just answer those 2 questions. What did you learn in this lesson over here? And then second, is there still anything that's confusing relating to this lesson or capital budgeting as a topic? Fahim, you can go first.
Hi, Faiz. I think the main thing that I learned in this lesson is that there is no tax implications for working capital. I didn't know that before. And with regards to capital budgeting as a whole, I don't have any additional questions towards it. I think I understand the concept well.
Okay. So if you do some more questions, you should be able to pick up whether that is true or whether you still need to brush up on certain things. Okay, so that's fine. Great to hear. Kelsey, any specific questions to this lesson? If not, then what did you learn? And then number 2, anything still confusing?
So I only have one question. Do you have to do the conversions for the exchange rates in this example the way you did them, or can we do them like dividing it by that amount? It still ties back to the same value that you have.
Exactly, yes.
Okay. Well, that's the only question I had was about the conversions.
Okay.
And I now have a much better understanding of capital budgeting. This hasn't been my strong suit before. So
Okay. And,
it does make a lot more sense.
Anything still confusing for you at this point in time?
And not at the moment. I think once I start working through examples, I'll have a better understanding.
Okay, cool. Lindo Cooley.
Hi, Faiz. How are you?
Good, good. How are you?
I'm good. Thanks for having me here.
No problem.
So I have quite a few questions.
Okay.
So my first question would be, so as I'm looking at this, it seems like we could have workings of more than 10 pages.
Yeah.
Okay, and then, so my other question then would be, if we will be using billions and converting rands into euros, I think it would be hard for us to keep track of everything. Could we use Excel in the exam?
I don't know. I think my brother did what you call it. He used Excel. So I think if it's an online exam, you can use Excel. For some people, they prefer writing. But if you can use Excel, like when I say can, as in you're quick at using Excel, will probably be better because you just basically take this format. You set up formats for yourself before the exam, and you just use a format and plug and play. And the format is going to be much easier. But like I said, there are people that prefer writing because they believe they are quick at writing because they don't use Excel on a regular basis, so they prefer writing. But I think you can use Excel. I think I'm gonna just check with my brother. I think he told me when he did the third year, he did Math 372 last year. He used Excel.
Okay. And then, and another question would be, how and why are we using, or how and why is there no tax implication for working capital?
Because working capital is made up of basically inventory and revenue, inventory and debtors. What makes up debtors is revenue. So revenue is already taxed over here, right? It's already taxed through the income statement. Inventory is taxed through the income statement. If you I don't know if you remember tax for inventory, you get a Section 11A deduction as a purchase, and then you have the Section 22(1) and Section 22(2) for opening and closing inventory. So to avoid double taxation, you don't tax working capital, is already taxed through purchases and is already taxed. The tax implications already come through purchases, and for debtors, it comes through revenue.
Revenue.
That is why you don't
Okay,
have
okay.
deferred tax on debtors. You don't have deferred tax on inventory because it's all already done with.
Okay, and then now I understand that. I didn't know that, and I was gonna include it everywhere going forward. Okay, and then my last question is now, why did we use, I didn't get you when you said why do we use the average in converting
Exchange rate.
instead
Exchange
of
rate.
the closing values?
Okay, so a closing rate gets used for a balance, so a asset balance or a liability balance, whereas for an income statement we use an average rate. So if you read the income, if you like normal accounting, they will do that, and then also revenue. So for finance as well, because we use it for a fee expense. Remember, that fee expense is happening monthly. It's not happening all at the end of the year. If we had to happen all at the end of the year, then we could have used that. But because it's happening monthly, we're supposed to use a monthly rate. This doesn't make we're gonna be here forever. So we just use the average for the year.
Okay, okay. No, it's understandable. That's all for me. I've learned more than two from what you told me now.
Okay.
So thank you very much.
Pleasure. I'm glad you learned a lot. Anything still confusing your side?
I'd like to know when are we gonna touch on capital rationing and the other one, what's it called? Equivalent
Annual
annuity.
question. Then when we do some integrated questions, I'll bring it up. Okay.
Okay.
Hardly comes in, but I will look. I definitely will find in when MAC 3702 came into play in 2014, 2015. I'm pretty sure they were in that times, but it's like they hardly had that because there's so many other real principles to test. But thank you. Any other thing?
Right.
That's all?
No, nothing else. Thank you.
Masina?
Hey, good day, Vezan.
Hello, hello.
Do you hear me?
Yes, I can hear you. So any questions or anything you have learned? Anything still confusing?
I'm good. What I've learned today, okay, I'll start with what I have learned. Okay, the first one, at the beginning and at the end, I wasn't quite sure or understanding what is the purpose. Each and every time, I think when we talk about the cost of investment, it started year zero. But from today, I've learned that you must also check the question that what the question says at the beginning or at the end.
Yes.
So what is confusing me, it's the one for the revenue. Why you have to cap it at that 100 billion? Because the information that we are having is saying it's increasing by 20% yearly.
Yes.
So
okay,
it's giving me confusion.
I'll tell you. So I'll tell you quickly, but just show you. So if I had to increase it, so I'm going to do this quickly. If I have to increase it by 1.20%, right? So if I had to do that, I'm going to end up with 1.103. But the question is telling me, that at full capacity, Kusasa is expected to generate and sell electricity of 100,000 gigawatts per year. So at full capacity, I can only have 100,000 gigawatts. In year 4, by applying the 20%, I get more than 100,000 gigawatts. So therefore, I have to cap it because I'm not going to get to 103 because my capacity is only 100. So that's basically the reason. Does that make sense?
So, yeah, I do understand. So, Faisal, if let's say the information that we have, it's saying it's gonna generate or operate at 40% capacity, how are we gonna get that
You're watching at a 40% capacity.
it's giga, what do they call it? Yes, if the question is giving us that the Eskom is gonna operate or
At
generate profit
40%.
at 40% capacity.
Then you must keep this at 40. So wherever they say, so let's say year 2 is at 40%, then you have to take full capacity multiplied by 40%, because they only can operate at 40% of full capacity. So if they had to say that, that is what we would have done. So for example, that's what they did in year 1. They said in year 1, they first said that the full capacity is 100,000, but in year 1, we're only going to operate at 60% of full capacity. So that's why we said 100,000, this million is just to convert it into kilowatts and to get and multiplied by 60%. So it all depends on the question. So why they're doing this is because they know many of us, we're just running through the question. We're not necessarily thinking, right? So they want us to think when we do the question. So that is why they're making sure that people are keeping certain stuff in check. So just make sure if you have any other thing specific, then you can ask me. But that is basically the explanation for that.
Okay. No, I'm okay.
Okay.
Maybe I'll read some other question when keep on doing some exercises or examples.
Okay. Okay, so that's all from your side?
Yeah, that's all.
Okay. Prashni?
Hi, Faiz.
Hello.
So from my side, yes.
Can you speak a little louder? Can't hear you so clearly. Softly.
Okay, sorry. From my side, can you hear me now?
Okay, yeah, it's a bit better.
With regards to the conversion, like in this case, with the conversion from gigawatt.
I can't hear you. I think you're breaking up a little bit. Can you speak a little bit louder? Or maybe put the volume of your thing a bit up?
Okay. Any better?
Okay, it's a bit better.
Okay. With regards to the conversions, in this case it was gigawatt to kilowatt. If for some instance in an exam condition I don't know what the correct conversion is, if I make an assumption to say I assume this is what it is, do my calculations based on that, will the examiner give me marks based on that?
So that is a touchy part, hey? I don't know whether they will give the marks or not, but in my mind, I don't know how they expect everybody to know every type of conversion. So I would just make an assumption, and hopefully in their solution, I never saw the solution, right? So hopefully in their solution, they would tell the person that is marking. But remember, the lecturers himself is not marking. They have people marking. So I don't know if one of the test points is that you must know conversions. But like, to be honest, I'd also gotten it wrong. I'd have made it by, what did I say, 1,000? I'd have multiplied by 1,000. So in that, like I would have said, I'm assuming 1 gigawatt is equal to 1,000 kilowatts. That would have been my assumptions. I did not know. Knowing the questionnaire tell me, they can't expect me to know all of these conversions, but whether I'd have gotten full marks, I don't know. I think what they would have taken into account is they'll give you full marks and maybe subtract 1 or 2, because remember, it is not also fair on the other person that knew that 1 gigawatt is equal to 1 million to get for that person to get full marks and for me to get full marks. So what they may do, because I know UCT used to do this, they will give you all the marks, because you're applying the principle correct and all of those type of stuff, your thinking is correct. It's only the only thing that the answer is not 100% correct because you used the wrong conversion based on what assumption you gave. Then they will just subtract 1 or 2 marks solely because to be fair on the person who would actually get it 100% correct. So I would think that you need to do the same because that is generally how they do it in the psyche as well, in the psyche exam. So you need to know how psyche would treat something. So basically, yeah.
Agree with that.
Any other questions?
No, none from me.
That's all from your side. In terms of anything confusing still?
No, I just obviously have to work through a few more
Work through it.
examples and then
Okay. Now that is so that is basically, so that's all from so there's no other questions, and then that's it from my side. I will answer your question now, Lindo. And then I will, the thing, once I switch this thing off, the thing will convert to a recording, then I'll send it to you guys a bit later. Probably take like about 30 minutes or hour or so, then I'll send it in an email. Okay. Remember, next week there's no lesson. So I'm doing the CTA guys, and then thereafter we will continue. Thank you very much. I know quite a bit of the Tax Act. Not every single thing, but yeah, I generally know the section and the application. Yeah, so most of the tax I do know. The section number with the application. Not everything, most of it. But you can message me privately, then we can talk offline. Okay. Okay, guys, I think that's all from my side. Anything else your guys' side? If not, then it's fine. We're good to go. I'll see you guys in 2 weeks' time. Thank you. Thank you. You too.